Mr. Kamakodi, the MD and CEO of City Union Bank, who's joining in to talk to us from there. Hi, sir. Thank you very much for taking the time out. Well, first wanted to start with the fact that, it is the season of farm loan waivers. You have a good 15 to 17% of loans which are focused on the agri space. Do you see a rise in defaults with some farmers maybe refusing to pay because of maybe some impact on credit discipline because of this?
We don't expect that way because you had larger comprehensive farm waiver in the year 2009. After that, we never see that as a broader phenomenon where the farmers start default. This is point number one. Point number two, specific to our own bank, bulk of our agricultural loan are backed up by gold as the collateral. So we don't expect this, particularly the announcement made from Maharashtra. And you also had a scheme of cooperative bank loan waiver in TN in the last year. It also did not result in any propensity to default, particularly on the farmer side. We don't expect this to be a major something which will disturb the repayment culture of the farmers.
So your slippages have been falling in the last couple of quarters, at least that's what we've seen. What's your expectation for Q1 of this year?
Yeah, as we discussed during the last discussion, we typically used to have about 1.25 to 1.5% of our closing advances slippage right up to financial year 13. It almost doubled to 2.8. From there, it moderated to 2.3, then 2.06, and we closed the financial year 16-17 with about 1.99%. We normally look into the slippage ratio as a year figure. There could be quarterly aberrations. In fact, even during the analyst con call we shared, but year as a whole, we are pretty, it is shaping in such a way that the incremental slippage ratio of the current year will further moderate from 1.99, what we have disclosed in the year financial year 16-17.
Okay, so broadly below 1.99% slippage for this year, you're not so sure of the current quarter. Is that how we should read it?
That is our hope for the whole year. There could be aberrations in the quarterly figure depending upon which type of account slippage and slip, and the individual numbers may vary. But year as a whole, we are pretty confident that the incremental slippage ratio should be moderate from our slippage ratio figure for financial year 16-17.
Sir, any particular reason you're not looking at, giving some sort of guidance for the quarter? Does that mean that there could be some troublesome accounts? Because we're almost pretty much at the end of the quarter. 2/3 of it is over.
Not exactly. In fact, about 2-3 accounts which we have been discussing over the period of last 6 to 8 quarters, even more than that, we were expecting them to slip, but they are continuously repaying and they were on order. This is something which you cannot predict. We have to see as you move forward, and you always had aberrations in the quarterly figure. I don't want to say that some figure is moderating, but answer you tomorrow after we see the quarterly results. But we are pretty confident that on an annual basis, the incremental slippage ratio is moderating, and we should be seeing the trend as a year as a whole, and there could be quarterly aberrations.
Okay, point taken. Will you need any capital anytime soon, sir?
We already have our Tier 1 capital ratio 15% plus, and when you see the growth rate of the market is not improving, you won't be seeing any immediate requirement for the capital. But as a strategy, what we are doing is that every year we go for the shareholders' approval during our annual shareholders meeting, so that approval will be accepted for the next 1 year. This year, we have to take a call on that, but every year we are doing that. But since our Tier 1 ratio is 15% plus, we won't be requiring any capital raising on an immediate basis.
What about loan book growth targets or the forecast for FY18?
For the financial year 17-18, we expect our growth rate should be between 15% and 18%.
And margins, they've been improving. Will they be higher in FY18 than in FY17?
Yeah, as we have been consistently discussing, this margin for the last year for all the 4 quarters had been well above the 4. Our 10-year average net interest margin had been in the range of about 3.5 to 3.75, and 4% plus is well above that, and we don't expect that to be a sustainable range. There could be some like say margin pressure which we are expecting. I mean, in fact we expected during the financial year 16-17, but it did not moderate. Depending upon the interest rate movement in the market, the current level is slightly on the higher side, and we anticipate some contraction in margin, but 4% plus is a very decent margin. Let us see how it goes over a period of time.
So it's the season of, talk about consolidation. Are you looking at taking over any MFI, any NBFC, or would you be willing to consider some of the smaller banks if this consolidation drive continues?
No, we had consistently maintained that our strategy will be purely on the organic side, and we don't want to look into, adding any extra risk to our portfolio and all. Our return ratios, be it return on equity or return on assets and margin, had been stable, and we don't want to disturb that. We would like to go ahead with whatever advantages we have created over a period of time, and we will be continuing with our existing organic strategy, whatever we have been pursuing so far.
Okay, have you been approached at all, sir?
I have been hearing this question at least for a decade, from 2003 when I joined the bank. We have consistently maintained our position that we will go ahead with our own strategy of growing on an organic basis, and we don't have any requirement of changing that strategy. We will be going ahead in the way we have been cruising so far.
The reason we're asking, sir, is that Fairfax is taking a 51% stake in Catholic Syrian Bank. So, it was just a question. We were wondering whether any PE fund or any other sort of foreign fund has shown interest in your bank, and whether you'd be willing if there was an interested party.
Yeah, in fact, we ourselves have our foreign institutional investor holding is close to 40%. Our first FII investment came almost a decade back. From that point onwards, we have been getting a reasonable capital inflows from the foreign institutional investors, both from the primary market and also on the secondary market. If you had a chance to look into these inorganic opportunities and all in the past, over maybe a dozen banks lost their identity in the past decade. If you had a chance to look into 90% of the cases, the mergers happened for the due to the regulatory pressures, or the banks had some issues or the other. So we don't see that as an option, and we want to pursue in our own way. And we are adequately capitalized, and we are getting capital at our terms whenever we need. We almost had about 3-4 rounds of capital raising in the past 5-6 years. We will be continuing to move in that direction, and we don't have any plan of going for a larger institutional investment at this point of time.
Okay, all right. We'll leave it on that note. Thank you so much for joining in.